This is an analysis from Alpha Business Media.
Welcome back to the deep dive. We're here to give you the clarity you need to navigate some of the world's most complex and interesting investment environments. If you're looking at emerging markets, you hear the same pitch over and over again, right? We're open for business.
Right. And policymakers, they spend a huge amount of energy on that first impression. The investment summits, the glossy brochures.
The metaphorical red carpet for foreign direct investment, for FDI.
But our sources today really drive home a critical truth. For any serious, sophisticated investor, it's never about the red carpet going in.
It's always about the fire escape going out.
Always. And
Yeah.
that's what this deep dive is all about. We're looking at Nepal, a country with, immense potential on paper.
But we're focusing on what is probably the single biggest non-commercial risk there, the repatriation bottleneck.
And we should probably define that right away because it's the whole game. It's this discretionary confidence-killing process an investor has to go through just to move their own legitimate tax-paid profits out of the country.
And the mission for this dive is to really understand why, because the sources are very clear on this. The problem isn't really a gap in the law.
No, not at all. It's a deep-seated institutional mindset. We're calling it the Forex scarcity complex.
So that's our goal today. We're going to dissect the operational side, the psychological drivers behind this exit barrier, and show why it systemically, maybe even unconsciously, filters out the exact type of capital Nepal says it wants.
The high-growth dynamic capital. Let's get into it.
Okay, so let's start with that first point you made. The law on paper versus the reality on the ground. The rule book looks fine, doesn't it?
It looks perfect. It's what our sources call a statutory illusion. If you just read the Foreign Investment and Technology Transfer Act, FITA, it explicitly gives investors the right to take home their dividends, their capital gains, everything.
A sovereign guarantee.
Supposedly, that's the government's formal promise. That's the red carpet. But the moment you try to actually walk back out on that carpet...
That's where the whole narrative just falls apart.
Exactly. And the sources really stress this point. Focusing on getting FDI approved is a strategic mistake. The real determinant of quality investment is the clarity, the reliability of the exit.
Because these big institutional funds, they have fiduciary duties. They can't just throw money into a black box where getting it back out is a question mark.
They simply can't. So let's walk through that gauntlet. Say you're an investor, you've had a successful exit, sold your shares, paid all your taxes in Nepal, now what?
Where does the process begin?
It starts simply enough. You file your documents, tax clearance, board resolutions, the sale agreement with the Department of Industries, or the investment board.
And these are the investment promotion bodies, right? They're supposed to be on your side.
They are, and they mostly just verify the paperwork, but they aren't the true gatekeeper. That role belongs entirely to the central bank, the Nepal Rastra Bank, or NRB.
And specifically, its Foreign Exchange Management Department. This is where it gets tricky.
This is where a procedural check becomes a kind of discretionary interrogation. It's the mandatory second approval.
So the central bank isn't just rubber stamping the first approval. They're essentially rejudging the entire thing.
Re-adjudicating it completely. And this is what's so damaging to confidence. The NRB will often start questioning the valuation of the sale, even if it was a totally normal arm's-length transaction.
Why? What are they afraid of?
They're haunted by ghosts of the past,
Yeah.
Things like transfer pricing, money laundering disguised as FDI.
So because they're worried about past abuses, every single legitimate exit today gets treated with suspicion.
That's it. They'll demand documents from years ago, sometimes even from the original investment. And every time they ask a new question, the clock on your application just resets to zero.
Which brings us to the timeline. Or, I guess, the complete lack of one. There's no statutory deadline for the NRB to give an answer, is there?
None. And that's what creates this state of perpetual limbo. I mean, getting your money out in 6 months is considered fast.
A year is not unheard of.
Not at all. And for a global fund, that is just an insane level of uncertainty. It's pure regulatory risk. It turns what should be your right into a favor that a bureaucrat might or might not grant you.
So what's the alternative? What would a good system look like?
It would be a green channel, rule-based. You show up with your tax clearance certificate, it's verified, and the money is cleared automatically.
Within a fixed timeline, say 15 days.
Exactly, something predictable. The current permission-based system is the single biggest roadblock.
Let's dig into the psychology behind that, this Forex scarcity complex. Why is the central bank an institution that should want successful investment, so resistant to letting capital leave.
You have to understand the pressure cooker the NRB operates in. It has this deeply conflicting dual mandate.
On one hand, promote investment. On the other.
On the other, protect the nation's foreign exchange reserves at all costs.
And for a country like Nepal, which has a big trade deficit and relies heavily on remittances to pay for imports, it's pretty clear which mandate wins out.
The defense of the forex reserves wins almost every time. Just, put yourself in the shoes of an official there. A private equity fund has a successful $50 million exit.
That should be a win, a sign the system works.
But it's not seen that way. It's seen as a $50 million hole in their fragile reserves, a threat.
So a successful private deal is viewed as a loss of a public resource.
Precisely. That $50 million could be, a few weeks of the country's import cover? So the institutional reflex, the scarcity complex, is to just crouch down defensively. The default response is delay, question, minimize.
Doesn't that feel incredibly short-sighted? I mean, surely they realize that attracting, say, $500 million in new FDI is worth the price of letting one $50 million exit go smoothly.
Logically, yes, but the NRB's key performance metric isn't long-term investor confidence, it's short-term stability. The immediate political pain of a currency crisis is real and terrifying, while the benefit of future FDI is, abstract.
And this whole situation is basically enabled by a specific policy choice about how money moves.
Yes, it all comes down to capital account convertibility. This is a bit technical, but it's crucial.
It's about the freedom to turn your local assets back into foreign currency and take them home.
Right. And Nepal has what's called full convertibility on the current account. So trading goods and services, like paying for an imported turbine for a hydro project, that's relatively easy.
But the capital side is the problem.
The capital side is locked down tight. The capital account governs moving financial assets. So importing the turbine is easy, but selling the power plant 10 years later and taking your profits home, that's where you hit the wall.
And the irony is that countries that really attract dynamic capital have learned that confidence is a better defense for your reserves than a fortress wall.
Absolutely. Global capital flows to confidence, not to coercion. If investors know the fire escape is clear, they bring more money in the front door. If they think they'll be trapped, they just won't come in at all.
Okay, so let's pivot to the consequences of this. This bottleneck doesn't just annoy investors, it actively shapes the kind of capital that comes into Nepal in the first place.
Yes, this is the investment filtering effect. It's why the country ends up with a suboptimal investment portfolio. The analogy from the sources is really powerful here. The system repels rockets and attracts rocks.
And we want the rockets. We're talking about venture capital, private equity, the high growth stuff. Why does this system push them away so effectively?
It's all about time. VC and PE funds run on a strict clock, usually a 7 to 10 year fund life. They have a legal duty to their own investors, their LPs, to return capital within that window.
Their whole model is based on getting in, scaling a company, and getting out with a profit in a predictable time frame.
Exactly. And a random year-long delay in getting your money out, it just destroys their financial models. It throws their fund-level returns into total chaos.
They can't make promises to their LPs if the exit is a complete black box.
And they don't even try. The end result is that these amazing, promising Nepali tech companies, the potential rockets, are basically invisible to global venture capital. The fuel they need just can't get to them.
So if the rockets are scared away, we're left with the rocks. What kind of capital is actually okay with this level of risk?
Two main types, really. First is what you'd call sticky or immobile capital. Think huge physical assets, hydropower dams, cement factories.
Things that take decades to pay off anyway?
Right. Their timeline is 20 or 30 years. A 1-year delay on repatriating some dividends is annoying, but it doesn't break their entire model. You can't just, pick up a dam and move it somewhere else. They're stuck there anyway.
And the second type?
That would be the patient or impact capital. We're talking about development finance institutions, DFIs, and foundations. Their mandate is a mix of financial return and social good, so they're just naturally less sensitive to commercial timelines.
And while that capital is critical, it can't be the only engine for growth.
No, it can't drive the kind of rapid commercial scaling a country needs to really transform its economy.
So the conclusion here is pretty stark. The repatriation bottleneck basically ensures that the investment landscape is dominated by these slow, heavy rocks, which prevents the fast, scalable rockets from ever taking off. It sets a ceiling on the country's growth potential.
It absolutely does. The country is, in effect, selecting against the most dynamic forms of capital.
So let's wrap this up by looking forward. For you, the listener, trying to make sense of this, what are the plausible scenarios for the future here? How should that shape your strategy?
I think we can map out three potential paths, and they really define the country's economic trajectory.
Okay, what's path number one?
Scenario one is the inertial path, basically the status quo. And to be honest, this is probably the most likely outcome in the short term. No real change.
The NRB keeps doing what it's doing, driven by that Forex scarcity complex.
Exactly.
Hmm.
FDI continues to be dominated by hydropower, DFIs, and some investment from the diaspora. The economy just kind of muddles along, and that frustrating narrative of potential just continues.
Okay, so what's a more optimistic but still realistic path? A procedural fix, maybe?
That's scenario two, the technocratic fix. This is where leaders recognize the operational chaos is just too costly. They don't do a full-blown liberalization, but they fix the process.
They implement that green channel we were talking about.
Precisely. They amend the regulations to force a strict, non-negotiable, let's say 15-day timeline for any application that comes in with full tax clearance.
And you'd pair that with a digitized single-window portal so files can't just get lost on someone's desk?
You have to. This would be huge. It would dramatically cut the regulatory risk and unlock a whole new tier of capital from funds that find the current uncertainty just too toxic. It's not a paradigm shift, but it's a massive operational improvement.
And what's the third most transformative scenario?
Scenario three is the paradigm shift. This is the big one. It requires a high-level political decision that investor confidence is a strategic national asset, more valuable than the dollars currently in the reserve. The goal becomes a sovereign, ironclad guarantee of exit.
How do you achieve that in practice? A full liberalization of the capital account seems unlikely.
It's very unlikely. The more practical route is by signing new generation bilateral investment treaties, BTs, with major capital exporting nations. These are serious, binding international contracts.
And the teeth in these treaties come from a specific clause, right?
Yes, the inclusion of robust investor-state dispute settlement, or ISDS clauses, this is the game changer. An ISDS clause would define this kind of delayed repatriation, a 6 or 12-month limbo, as a form of indirect expropriation.
Meaning the investor could sue the government itself in an international court for damages.
Exactly. It shifts the financial risk of bureaucratic delay from the investor back onto the state. That creates an immediate, powerful incentive for the state to fix its own processes permanently.
That would be the only thing strong enough to overcome that deep-seated scarcity complex.
It's the only thing. It would instantly put Nepal on the map for serious global private equity and VC.
So that brings us to the hard truth that kind of ties all of this together. Nepal's institutional obsession with hoarding dollars is the very thing preventing it from attracting a flood of new ones.
It's basic plumbing, really. If you
Yeah.
clog the drain, the sink can never fill up, no matter how wide you open the tap. As long as that exit door is a heavily guarded, unmarked passage, the world's most dynamic capital is just going to say, no thank you.
So the bottleneck isn't really about laws or infrastructure. It's about institutional fear.
It's all about fear. And that leaves us with a final thought for you to take away. Until policymakers everywhere truly internalize that the most powerful magnet for investment is a guaranteed, frictionless exit, how can any emerging market really compete for the global capital that can transform an economy?
Because that confidence is the only currency that truly matters in the end. A fantastic breakdown. Thank you for joining us for this deep dive. We hope this has given you the clarity you need.